Hello. Today in less than 5 minutes, K&G International Advisors will give you a summary of last week's most important international financial news, focusing on searching for bull markets catalysts. This is part 1, titled Pivot or Pause. Dominion Capital Strategies has over the past 2 months reiterated their view of the current bear market cycle and that it's likely to persist until at least one major catalyst for a new bull market occurs. Over the coming weeks, we will be digging deeper into what we mean by this and explaining what investors can be looking out for as early indicators for one of these bull markets catalysts materializing. First things first, what do we mean by a catalyst? This term, as with many others in professional investing, is borrowed from another industry. In chemistry, a catalyst is a substance that causes or accelerates a chemical reaction. When we talk about catalysts as investors, we are using the word to describe an event or an outcome which will cause or accelerate a major change in markets. This catalyst could be political, economic, or specific to an industry or company. Whatever the case, it is the catalyst which will cause the change we're looking out for. In the case of the current market cycle we're in, a catalyst for a new bull market would be some outcome or event which would cause a major change in markets and act to drive a new bull market cycle. This week, we will be talking about the first catalyst we're looking out for, which is likely to drive a new bull market cycle in stocks, namely a pivot or pause in central bank policy. Central banks in most of the developed world, led by the US Federal Reserve, are raising interest rates. Last week, the US Federal Reserve again raised interest rates by 0.75%, bringing the US rate from 3 to 3.25%. The Bank of England raised its base rate by 0.5% to 2.25%. Rates in these and other major economies were effectively 0% at the start of the year, and this rapid change marks one of the fastest increases in rates in history. Central banks are doing this in response to the highest rates of inflation in 40 years. Higher rates are the best tool available to central banks to try and fight inflation. By raising rates, access to debt capital is reduced by making it more expensive to borrow. This in turn feeds through the slowing economy activity, which acts as a brake to inflation. This process has a major effect on financial markets and asset prices. Higher rates and the prospect of slowing economies grows means, for the stock markets, a higher likelihood of reduced corporate profit growth, and thus equity markets can often see bouts of selling. This selling can be especially pronounced when the starting position for equity markets is one of high valuations, as was the case at the start of 2022. As such, a change in central bank policy away from raising rates and towards either pausing or pivoting into rate cuts is a big deal for markets. Equity markets have in the recent past seen very strong positive rallies simply on a hit from staff at central banks that they might consider a pause or pivot in policy. Currently, there is no serious talk of pausing rate hikes, let alone pivoting into rate cuts. But we do know that there is a growing difference of opinion within central banks. Some, like the US Fed and Bank of England, hold committee meetings where members vote on what the rate decision should be. We can see by looking at these decisions how many members of each respective committee voted for either rate hikes, pausing, or pivoting. In the case of the Bank of England, most recent decisions, all members voted for a rate hike, but one member did argue for a much lower hike than was agreed. This is an early indication that there is some resistance to current pace of rate hikes. There is some early indication of similarly marginal but growing resistance to the current policy for big rate hikes in the United States. What typically triggers a pausing or pivot in central bank policies is a major slowing in the economy. The prospect of much higher unemployment and even economic recession can, and has many times in the past, forced the hand of central bankers to change direction. This again is an early indicator for a potential change of policy, evidence of a dramatic economic slowdown. We're not there yet in either case. The economy doesn't appear to be slowing, but not drastically, just yet. And there is a scant evidence of an imminent central bank policy pause or pivot in the near term either. It helps, however, for investors to understand that when a pause or pivot eventually looks like a real possibility, that will be a good time to consider ramping up allocation to equities in anticipation of a major catalyst for a new bull market. We are not there yet, but it helps to be on the lookout for the early signs of catalyst like this before they occur. The sources used on today's video were Yahoo Finance, Bloomberg, and Dominion Capital Strategies. My name is Juliana Lato from K&G International Advisors, and we wish you an excellent start of the week. Also, we would like to thank you for watching our video. Don't forget to subscribe to stay updated on all the important financial news, and don't hesitate to contact us if you have any queries or further comments.